Fellow traders, good morning. Mark Heareth here from Fly Trading. It's Memorial Day. I hope you're enjoying the holiday as we take this time to commemorate the men and women who've sacrificed their lives in service of our country. Hope you're enjoying yourself in some sort of safe and outdoor activity. And when you get to it and come back inside, I'm sure you'll be thinking about the markets, what's going to happen this week, and so we'll talk about that. And basically, technical analysis is showing that the markets are definitely moving and grinding higher and have some impetus and momentum to do that. And also, it's not going to be a one-size-fits-all. I mean, there are key sectors that are growing and others that are not. We'll take a look at that and how potentially we could benefit from that. Remember that this is for educational purposes only and not a recommendation to buy or sell any specific security. Okay, so let's jump in on the technicals like we always do. And let's go here. And let's take a look at the S&P 500 futures. Yes, even though this is Memorial Day, S&P 500 futures are open to 1 p.m. Eastern Daylight Time. And you can see that we are approaching that magical milestone that we've talked about of 1,000, right? You can see that we're right here at this 29.97 level. And this is going to be key, right? We're going to be key to see whether or not this holds. You can see that we broke, right, this overall trend line that we had right here. We broke through, we closed above it. That kind of coincided with the top of value, for the month. And so at this point in time, now we're kind of in this juncture of a hold. What happens? Do we hit this and then bounce back down? Maybe kind of bounce sideways for a while until we get more information from the market? Or potentially does it go higher? Does it come up here to this next level of the 7186? As you can see, there's not a lot of, if you say key resistance until we get to this point, right? We always look left to be right. And so that's one key area we can go to. In the shorter term, if we do kind of bounce above this, one of the things that you may want to look at is on the weekly chart, we have this top of value area here at this 3022, and this is really key in the sense that we may go a little bit higher and bounce back. So one of the key things I would look at is that if we do actually get through the 200-day moving average, is number one, that we hold it. But myself, I'm probably going to wait for not only a push through and a close, maybe consolidate a little bit, but I would look for a check back. And at that check back here, that would give me a really good stop standpoint. I could put a stop underneath 3,000 and then watch to see it grow up here to that 3,100, 3,130 level. Okay, so one of the key things we talked about are all the indexes. They're all kind of moving together. And if we look at the NASDAQ, we could also see that we are in that same boat, right? We are above the top of value here on the daily chart. We are above the 8 EMA, which is this yellow line, and we are fast approaching this pink line, this VPOC, this Virgin Point of Control. Basically, this is an area where buyers and sellers have kind of come to an equilibrium, and those things tend to get retested. You can see we're very close. You can also see that it corresponds very well to kind of the symmetry that we've talked about. I took the liberty of drawing this already for you, is that the symmetry of this last up pick here from 100% to this 100% really kind of shows confluence at that level. And short term, you could kind of expect to see the NASDAQ, touching that 9,600 level. And that really even looks more of a confluence over here on the weekly chart. Now, if it breaks through, of course, then we have the all-time highs, which then correspond to the 9,800 level on the 127. Again, I would kind of look to see, personally for myself was, I don't want to get caught in one of these, false breakouts coming here where it looks above and then comes back down. I like to see it come up, retest, and then push higher. And lastly, we could look at the small caps, and you can see that we have confluence there as well. And look at that confluence, we can see that we've broken through resistance in a number of different places. Number one, right, we had our channel right here. We broke through that, which kind of corresponded to our 50% retracement. We've closed above it. We bounced off it, right? Pushed through, closed above, retest, and now we're pushing forward. The next target, of course, logical target here is the 618 retracement, right around that 1400 level. Again, another magic number. So you can see that here easy. I'll say a little bit better on the weekly chart. Not only do we have the 618 retracement, but it really does correspond very well to, this start right here of a good level where we opened before we took this big drop. So I think that would be a good place to pause and definitely take profits and moving up stops if you're in the short cap. And of course, we're still within the channel moving forward. So a lot of people are still thinking, why are we still moving forward given we're still in the midst of this pandemic? And so we want to take a look at that. And remember, we may have our certain personal biases and irrationalities, but you have to ignore those. You have to look at the price action and trade in front of you. You can't always know and wonder why. A lot of times why does not become evident until, months later, but we can kind of look at some of the key drivers and potentially some of the timing that may be associated with those in the future. So let's go ahead and go back to the PowerPoint here and take a look at kind of the rally killers and some of the push and pulls of what we're talking about. So we're going to go here we'll go to the presentation mode, and we'll just kind of swipe it out because I got multiple screens up. So let's look out, everyone's thinking, why? We're still everyone's kind of, tepid in the sense of, I really don't want to jump in. I'm still kind of bearish. Well, there are reasons for that, of course, and one is basically the US-China tensions, right? At this point in time, there's a lot of tensions. Some of them are economic, some of them are political, right? We don't need to get into those, but the key thing is at this point in time is that they are kind of moving forward, and they have talked about, which has sent some tremors in the market, about not paying the debt on the interest debt on all the treasuries that China owns. Now, I think that was just more of a saber-rattling piece that would really just collapse the whole economic structure based on the U.S. defaulting potentially or selectively defaulting on debt. So I think that was more just a posturing piece than anything else. Reparations, kind of the same thing. I really don't see how they could actually force that to happen in any kind of the world court and the world bodies. But one of the things that has happened is that President Trump has definitely enacted the piece where that the U.S. pension funds, represents a good sizable chunk, will not be investing in Chinese securities, going forward, and that's going to shake up the markets a little bit. At this point in time, the market seems to be shrugging that off, but it's still something to think about. I think the key thing here is, we talk about unemployment, and at this point in time, looking at both sides, you can see that unemployment, at least the claims themselves, is stabilizing, even though we're at 38 million. The key here is that these 38 million, everyone's expecting this kind of, V bottom, that the economy is going to, jump back in and restart. Well, unfortunately, I hate to say it, but it's not going to happen. And the reason why it's not going to happen, because right now, there's a majority of these companies are basically they're laying off, right? They're laying people off permanently right now. They're not on furlough anymore. They're starting to see that there's just too much to overcome for kind of a 90 to a 100% snapback in the economy, not the market, right? Not the market, the economy itself, right? These are two separate things. And because of that, folks are going to basically encounter economic difficulties into paying their bills, number one, and also contributing to the economy. Remember, the consumer is 70% of the economy itself. So we can see here that the Q2 forecast, the latest GDP now, is saying even though we've come out at an interim at 28%, that we could drop all the way to 41%. And the key thing is that we're starting to see, as the safety net of the Fed kind of reaches, to say, a time horizon, if you will, is that now we're seeing the economic pressures start to mount in the form of people not being able to pay their bills, and especially around mortgages and mortgage delinquencies. And this is, it's not only going to be mortgages, right? You look at our debt, you look at student loan debt, you got to look at your auto loan debt. They're all at record highs. So I think this may definitely hit the market at a later time, but not at the moment. And not at the moment because the economy is starting to reopen. So we've been at the worst of the worst, supposedly, right? And so everything looks like it's going to get better. Things are starting to happen. Money is going to start to change hands. So that velocity of dollars, which kind of helps stimulate the economy, yes, that will have definitely, positive effect. Hopefully, right, that these huge and horrendous economic numbers are stabilizing, right? The downward slope is continuing, and hopefully these will bottom out, right? So again, trying to say that we're hitting the all-time lows. The promise of recovery, potentially vaccinations. Not only do we have remdesivir, but the U.S. government has basically put together another $1.5 billion that it's pumping into different pharmaceutical companies to help speed the development and the access and overall production of some type of vaccine or therapeutic to lessen the impacts of the coronavirus. Right? The Fed is still printing money, and as long as the Fed's printing money, then people don't have very much fear. And it's not only our Fed, right? The other central banks just released this week, right? The ECB has come up with a $500 billion plan, and the Bank of Japan just announced last Friday a new set of loans going out to different businesses, in the form of almost $1 trillion. I think it was 948 billion, something like that. So looking at these things, I think that the short term, again, don't fight the Fed, is still overcoming what some of the economic realities are. And basically, because the Fed is still, pushing and projecting, that the market still has, I should say, no fear and is still grinding higher. At some point in time, I think this will catch up with us. I can't tell you exactly when it's going to be. We will look at the technicals to help make that determination, but it's not going to be now in the next week or two unless something, unforeseen happens. So let's look down and see what else we got here. So one of the key things too is, right, we talk about we have bonds, but there's really no bond market. So with the Fed buying, all the treasuries and also the mortgage-backed securities, you can see what has happened. You can see that we no longer have price discovery, and at this point in time, we are trading in a very, very, defined and narrow range. And because of that, right, the Fed buying securities, the volatility, which is the MOVE index, right, that's the volatility of bonds, they have stayed the same. What this tends to do, it provides interest rate control. So basically, the Fed, by its actions, is telling the market, look, we're, even though we're pumping all this money in, we're not going to let inflation, come to pass. I think on the other side of it, we have potential for a deflationary period, but you're going to have low interest rates, and therefore the access to cheap money for the foreseeable future. And as long as folks can secure those dollars, okay, and pump that in, I say folks, I mean businesses, can secure those dollars and therefore extend their lines of credit to help them over this hump in the pandemic until the economy reopens, then I think the market is going to remain mostly optimistic. Okay, so we take a look at that, and we kind of move down here, and we talked earlier before about not all sectors were created equal, and I think it's very important here that we take a look at and see what is happening. And if we take a look at kind of the NDX and basically the QQQs, you can see that they have by far outperformed the rest of the different indexes right here, right? We have all this space where our next, competitor is the in the S&P 500 and the NASDAQ, and even the New York Stock Exchange. There's definitely a measurable increase of what's happening. And so as you know, that the NASDAQ is technology based, and you can see that it's here, it's 56%, based on technology. And that seems to be growing. And that growth is perpetuating that much higher than, say, the S&P 500, which is still seeing some comeback gains, but not nearly as much. And you can see even here, if we take it down to another level, right, from a sector perspective, is that our healthcare, communications, technology, right, these sectors are the ones that are performing best. And these are the sectors that are not performing as well, and all sectors aren't created equal. So therefore, if you're investing, would you rather be in the top sectors here, or would you rather be in the bottom sectors? And obviously everyone would like to be in the top sectors. And you can see the S&P 500 is growing, but now, and it's come back, and we're talking about that 50% retracement versus, we've seen on the NASDAQ that we're way above the 618, approaching the 78.6. Is that the different weights in technology that we have here, right? We're only at 21%, and here we're at 56%. So the question is, how can we take advantage of that, going forward, and also realizing that this is kind of a narrow push, and it's basically a new economy, spurred on by the pandemic itself. So if we take a look, one layer deeper, and what I'm showing you here is this RSP is the equal weighted S&P 500 versus the weighted S&P 500. And you can see that the weighted S&P 500, okay, is outperforming, right? Because this curve is down and low. If the equal weights were working well, then this curve would be moving up and to the right. But anything downwards means that the base index is overperforming based on the weight. And based on the weights of what we're talking about, it's right. We already saw that we had 21% weighted toward technology, and market cap wise, that technology is definitely driving that, along with some of the communications and the health services. So again, another look at it, that's where we want to be. The same thing even in the QQQ. So if we really take a fine look at this, if we look at equal weight QQQ versus the overall NASDAQ, you can see that the overall NASDAQ, the weighted piece, is still pushing harder. So the key is we want to be in that weighted piece, or at least a portion of the portfolio, in order to potentially outperform the markets, or at least from a technology perspective. Where do we need to be as far as this new economy is, as it develops? Well, let's take a look at what we talked about before, and we'll get some areas to take a look at. Now remember, the pandemic, and should we say stress in general, tends to accelerate trends in the economy. So even before we had this pandemic, right, we knew that e-commerce was big. We had, Amazon Prime Day. We had, basically, Cyber Monday, and even Black Friday, and everything was moving away from retailing shops. But now, right, that's moving away even further. And as you move away further, so e-commerce becomes, a larger part of the economy, and the service economy, then let's also take a look at what drives and what underpins e-commerce. Well, if you're talking about all warehouses, then you know what? Then you need robotics, right? You're going to see more and more of kind of that, place and pick parcel piece going forward with, kind of artificial intelligence driving those warehouses further. You're going to see that as more and more e-commerce happens, that we're going to come to a cashless society, right? We're going to be using different forms of credit. Right now, you can't even use cash, even at, I should say, most businesses that are considered, needful to be open, right? You have to use some type of credit card or Square or some other piece. So this whole idea of a cashless society, that's going to come on. Well, then think about the rest of the e-commerce value chain and its delivery. And this drone piece is going to start to pick up. Right, more and more people, they're saying right now, Facebook, all the big tech companies in California, they believe that working from home is going to be more of the norm, going forward. A lot of these conferences are going to be remote. So these types of conferencing, software, Zoom, et cetera, signing of documents, how to make teams more effective, right? All these things are going to be, are here to stay and growing, and they're going to keep moving, I think, into new and innovative type places. The same thing, in order to, I'll say, let's just say power, e-commerce and remote productivity, you're going to need the internet. You're going to need base components in terms of hardware. You're going to need infrastructure in terms of bandwidth. You're going to need towers in terms of 5G. You're going to need software to run all these different applications. And of course, you need chips then to run, not only the infrastructure itself, but the software and the AI chips and everything else. So that being said, this is where the growth is happening, and I'll show you this on a chart or different charts in just a second. But the key thing is that some of these sectors are approaching key resistance areas. They're getting to be expensive. They're getting to be overbought. So there's a word of caution out there. You're buying at the relatively all-time highs right now if you enter into these things. So, talk to your financial advisor. Look for pullbacks to make things happen. The second thing is that this growth base is very narrow. So one little blip, flip, or HIPAA, all right, could definitely kind of change the market. And if these things are considered overvalued, they will reset quickly. So it's not something you want to just be 100% in, just given the overall risk, right? Because the diversification, even though you're diversifying in technology, isn't exactly there. So you can see that, so one way you can look at this is saying, if I look at the way I want to go ahead and have some diversification, I can just say maybe instead of, since bonds are basically going to be potentially flat, and kind of that's 60-40, should say portfolio allocation, a lot of people and financial advisors talk about. Maybe you want to be more 60-40 in the indexes between, the SPX and the QQQ. Now, of course, if you want to get a little finer point on it, you go into the sectors. We talked about those sectors. And you look even at XLK, right? It's there. That's a general, broader-based technology. But then let's look at what we've talked about before, right? From the software, we've got IGV, we look at the cloud sector, the internet, e-commerce, and the semiconductors, healthcare, right? We break these down as well. So now it's, it gives you a much better base and a little bit more diversification to, I think to use in ETFs and look at sectors, because all these hedge funds and everything you start seeing in literature these days is talk about stock picking, and stock picking is back, and it's not passive indexing, index ETF investing anymore. I would tend to disagree with that. I think hedge funds and hedge funds returns have been abysmally low, especially the past 4 or 5 years, because stock picking is extremely hard. I think that if you take a look at the economy and basically the analysis we just gone through, just and some of the examples around e-commerce, remote productivity, I think it gives you a better example of where those sectors are going to be, and that from a risk standpoint of not only being somewhat diversified, but also putting a wider net out there to capture returns. I think that sector ETFs definitely provide, should we say, something to definitely take a look at in order to take advantage of. And let's take a look at some of these real quick, and we'll look at them both relatively and absolute. And so we'll do that right here. So if we look at XLK, we can see that it looks a lot like the NASDAQ in the sense that we've come up. But again, we look at a sector analysis, and we compare the XLK sector versus QQQ. All right, you can see that it's kind of flattened out. Even though it's come up, it hasn't gotten all the way there. So the way to take advantage of that and peel that back is to look at some of the the individual components that make up the technology sector. And one of the things we talked about is software, right? And we look at software right here. You can see again we're almost at the all-time highs, but the key thing is that when you compare it to the QQQ, you can see that we've definitely had a very good, and looks like we're ready for potentially another breakout, as far as this leg up, right, to represent a potential outperformance of the QQQ as well. Because remember, all sectors in technology are not created equal. And the same thing, we talk about everything is going to be done in the cloud. You have to create it the cloud. Everything's going to be done kind of remotely. Also, to get these new applications online, everyone doesn't want to buy software. So if you look at the cloud from a perspective, and you can see that, again, we're almost approaching, all-time highs. And of course, you're going to see the same type of relationship here, that when you look at it compared to the NASDAQ, is definitely moving up and above. The same thing happens with your infrastructure on the internet, right? Look at FDN, right? Here we have cleared, and we are at all-time highs. So again, a little bit extended, right? You definitely want to look for a pullback before you get in any type of position here, as this is more or less overbought. And of course, e-commerce, because we talked about Amazon. It did. Oh, I'm sorry, bad typing. It did pop a little bit last week on that daily squeeze that we talked about. But obviously, that's a $2,500 stock. But if you go into iBuy, you get and Shop is also another kind of e-commerce infrastructure software supporter. That's also trading at $600. You can be, basically, getting exposure to this at the $63 price point, which is a little bit more cost effective. Okay, the same thing goes for the other sectors. I'm not going to go through those. I think you guys can do that by yourself. I think it gives you a very good picture of how these technologies are kind of outperforming. I would say the last one, though, that is a little bit key, I'd like to say, is that, again, take a look at iPay. Right now, iPay from the financials. The financials are not doing very well at all. Let's take a quick look at that. Let's look at XLF. Right, they are not moving. That's going to hold back the S&P 500. Remember, the S&P 500 had about 17% allocation financials. The NASDAQ had less than that. I think it was in single digits, if I remember off the top of my head. But we talked about how we're going to go to a difference in payment structures. And if you look at, iPay, you can see that's moving. And you can see, even if you guys are looking to do stock picks, I would definitely say take a look at each one of these ETFs. Look at the top 10 holdings and look to see which ones are doing well. In this case, you can see that, PayPal is, they're basically all up at new all-time highs. Others like Square are also, kind of in that same boat and outperforming even iPay. So that's the way, if you really want to get down to the stock picking level, that's one approach on how to do that. The same thing, I think the other key area we talked about more longer term is on renewable energy, and you can see that the TAN is moving up, and it's, even though it's something that is not potentially quite sexy, but it is something that folks are going to move to because they can control the total supply chain and not have to rely on the Mideast. If you look at it compared to even the QQQ, it does have higher highs and higher lows. Now remember, this is a much longer term type of a bet, and I think that once you clear that 200 moving average there in the red line, I think people can be in really good shape for a long-term consideration. And then lastly, I would say is, the other thing is the entertainment and the gaming industry, and also, so we look at the gaming industry type here and the entertainment side of things. They are also cruising. I don't think that's going to change, especially that even though we get sports online. Sports will go back, but we will not get fans. I think that the gaming piece, where people are actually active and have something to do besides just watch it, will continue to move. It's also, should we say, it brings a lot of people socially through the communications and the headsets. And lastly, back to the sports piece, the overall gambling part of it, I think, is going to be an even bigger component. Now, we saw this weekend, right? DraftKings was up there, pushing different odds on the Tiger Woods, Peyton Manning, Tom Brady, Phil Mickelson piece, and you can see that been in DraftKings for a little while, but that stock is basically kind of new, but that's also pushing up, and I think that's an area that's going to continue to grow. Okay, guys, that's it. That's what we have for you this week. Hope you have a great Memorial Day, and we'll catch you on the flip side.